purpose of the purpose of this presentation is to show why it makes sense to look at your Irish income tax obligations now rather than waiting later in the year. The benefit of filing early means that you know now where you stand, you know what you have to pay later in the year in October and November. If you're due a refund, you can get it now. Filing your tax return early doesn't actually bring forward payment date for tax, which is often a misunderstanding by people. So do it now, understand more now, get money back now if you're due it, but know what you have to pay in October and November. And at this stage being about February, March, it gives you 8 or 9 months to plan your cash flows. It also means that there's less risk that you're going to miss something if your tax return is filed later in the year. So who has to file a tax return? Somebody who's under what they call self-assessment. So if you have income that is not subject to the PAYE system, so for example, rental income, investment income, dividend income, foreign income, pensions, that kind of stuff. And in addition, you also have other obligations in relation to capital gains tax, gift or inheritance tax. So we talk about a chargeable person to the definition on the screen there, and in essence, it's if you're not taxed through the PAYE system. But there are important exceptions to that for a company director. So a proprietary director, which is somebody who owns more than 50% of a company, is always a chargeable person, irrespective of whether they have other income or not. And this can often come as a shock to a director who hasn't filed a tax return if they think, well, sure, all my income is taxed through the PAYE system, I've no balance to pay. But the problem is they're exposed to a surcharge because the surcharge is calculated before crediting the PAYE deducted from their salary. And in addition, company directors only get a credit for the PAYE deducted when that has actually been paid over by the company, which again can come as a shock, especially if a company is in financial difficulties and went into liquidation. So with the PAYE system and pay and file, 31 October is the important deadline. That extends generally to the mid-November, which is announced every year by the revenue. And on that date, you have to pay your preliminary tax for the current year, file your tax return for the previous year, and pay any balance of tax also for the previous year. If you do file your tax return by the 31st of August, the revenue will calculate your self-assessment calculation for you, but that's not a big deal in any event. So how much is preliminary tax? You have 3 options. You can pay 90% of the current year, so that involves a guesstimate because the tax year isn't over yet, and if you underpay it, you're exposed to interest. You pay 100% of the final liability for the previous year, which is a known amount and is generally the most popular option. And a lesser known and lesser used option is to pay 105% of your final liability of the pre-preceding year. So in this case, if you were filing for preliminary tax for 2025, you could look at your 2023 tax liability rather than your 2024 tax liability, but you have to pay that by direct debit. And what happens if you don't pay it on time? In simple terms, you're exposed to interest. And interest by the revenue is at a rate of 0.0219%, which mightn't sound like an awful lot, but over 365 days is about 8% per annum, and you don't get a tax deduction for that interest if you're a business. Some people consider it just like an overdraft, and if they don't have the money, they don't have the money, and they'll just, suffer the cost. So also, if you don't file on time, you get hit with a surcharge of 5% of your tax liability if you file it within 2 months of the deadline, and that rises to 10% if you file after 2 months of the deadline. So even if you don't have the money to pay the tax, file the return on time so you don't get hit with a surcharge. And as I mentioned, for directors, the surcharge is based on their liability before crediting or PAYE paid. There are a number of ways you can be assessed for tax, which I just mentioned, single and joint, and separate, which you should discuss with your tax advisor to see which is the most advantageous for you. But also to bear in mind that in certain circumstances, there are other things to be considered in the year of marriage, year of separation, or the year of death. And if they apply to you or somebody you know, reach out to your tax advisor. PRSI is something to consider, especially if you're over the age of 66. If you're in what's known as family employment, because you might find you're actually an accepted contributor and you're not actually contributing in PRSI. So you might want to become what's known as a voluntary contributor. So you're building up your stamps for an old age pension down the road. If you're a holder of a full medical card, you would want to let your employer know because there's a reduced rate of PRSI to be paid, and if you don't tell them, they won't know. Taxation in Ireland is based on concepts of residence, ordinarily residence, and domicile, which I won't get into in great detail. But if you were somebody who was not domiciled, somebody who was not from here, so to speak, the taxation of certain income can be affected by your domicile. If that applies to you, talk to your tax advisor. Also consider whether you have any double taxation relief that can be applied. So looking at typical types of income that people might have, rental income is one, and in filing your tax return, there's a little box that you tick to say you've complied with certain obligations under the Residential Tenancies Act. And in essence, that means you've registered the tenancies with the RTB. The main thing is if you don't do that, you lose out on the ability to deduct interest on the loan you've taken out for the rental property, and that could be a very significant cost. For rental income, it's set out what kind of expenses can be deductible, which I've set out on the screen. One that is often missed is a mortgage protection policy. So if you've taken out a mortgage protection policy to cover the mortgage, you can get a tax deduction for that cost. There are certain costs that you can't deduct, for example, your own labour costs. So you go to your rental property to fix something, you can't claim your labour, you can't claim your travel costs. And similarly, if you have an RTB fee for being late, you can't deduct that. There is a relief brought in for residential premises rental income tax credit, but the amounts are relatively small, and I just mentioned it in passing. You can see it ranges from €600 for 2024 up to €1,000 in 2026 and 2027. But there are terms and conditions to apply, and there are clawbacks that will apply as well if the property ends up not being a qualifying property within a certain period of time. Looking at employment income, certain categories of employment are able to avail of what's known as a flat rate expense, and I have a link on the screen, and it gives you a little bit of an extra tax credit. So people, for example, like nurses, they get an extra amount to cover the cost of laundering their uniforms. If you're working from home, you'll be able to claim a remote working relief where you get a portion of your light and heat and broadband costs based on the number of days you've worked from home. If your employer has reimbursed you certain money, you'd have to net that against it. So, for example, the employer can pay €3.20 a day to people working from home. If you are working in certain countries, there is a thing called a foreign earnings deductions, and if you work abroad, talk to your tax advisor to see whether that applies to you. Share options are mentioned because it has a periodic focus from the revenue in terms of whether or not tax has been paid, which is now more regulated, but especially whether capital gains tax on disposal have been accounted for. If you have your own company, don't forget the small benefit in kind exemption, which is basically a tax-free voucher you could receive, now up to €1,500. It was €1,000 in 2024. And similarly, if you have your own company, consider your spouse or partner and whether or not there is justification for them to be on employment of the company to also be able to avail of a small benefit in kind exemption, to also then down the road be entitled to an ex gratia termination payment, and down the road that you fund a pension for them from the company. Typical foreign income that people may have would be dividends, for example, from America, from the UK or Europe, and ensuring that that's included on the tax return. Any encashment tax is included for a credit. You may have foreign employment or pensions, and every so often the revenue do a focus, and a number of years ago they looked at people who had UK pension or US pension and hadn't been returning it in Ireland. You might have a foreign rental property because you bought a property in Bulgaria or Spain or Portugal or France, and you have to remember that you have to include that in an Irish tax return, even though the property is located abroad. So even though you might be filing a tax return abroad, you still have to file a tax return in Ireland, and you might get a credit in Ireland for whatever you pay abroad. As an aside, you want to consider whether you need to make a foreign will as well to consider that property. Offshore funds, as just mentioned in general, if you have them, you'll know what they are, and there are disclosure requirements in relation to them. Other typical Irish income that people would have would be dividends, bank interest, interest or dividends from the credit unions, and maybe maintenance payments. And if you have any of those, they do need to be returned on your tax return. Thankfully, there are some exempt types of income. So artist exemption is one, but you need to apply and be approved to be an artist. It exempts you from income tax. It doesn't exempt you from USC or PRSI. Rental room relief is a popular relief for people renting out a spare room. And if you receive up to 14,000 in the year, it's not taxable. If you receive 14,001 euro, it is fully taxable. It's not just on the excess. And the 14,000 is determined by what you receive for everything. So for rent, contribution to utilities, etc., etc. If you carry out childcare services at home, there is an exemption, but you have to disclose it. So what can you deduct against your tax liabilities? Maintenance payments. So if you're in a situation where you're making payments to a former spouse, you can deduct those payments where it's under legally enforceable agreement. So you deduct it and they're taxed on it. If you make pension contributions, what's to remember is that you can make a pension contribution after the end of the tax year, before the tax filing deadline, and opt to set it back to last year. So you would have until the 31st of October deadline or the mid-November deadline once it's announced to put money into a pension, and subject to limits, offset it back against your 2024 liability. If you have income protection policies, you can claim that subject to 10% of your income against your income tax liability. If you have college fees, you can claim that again against your tax liability. There are certain limits and exceptions in calculating it, but you can look at it. If you look at what's known as a dependent relative or an incapacitated child, there's a small tax credit you can claim. If you're in rental accommodation, there is a rental tax credit that you can claim where you provide certain details to the revenue. If you have children and you have a spouse living at home, looking after them and not working, there is a home carers tax credit that can be claimed. If your employer provides you with medical insurance and it has been taxed as a benefit in kind, there is then the tax relief at source that you can claim on your tax return. It's worth 200 euros per adult. They introduced in recent years a mortgage interest tax credit where they look at the amount of a loan you had at the end of 2022, and if it's between 80,000 and 500,000, you qualify for the relief. And then it's looking at the amount of interest that you paid in 2022 compared to the interest you paid in 23, or your interest in 24, and on the excess, if you paid more, you get some tax relief. For medical expenses, you get that at a 20% rate of tax. Certain medical expenses can only be claimed where they have been advised to be obtained by a doctor. So, for example, you decide to go to a physiotherapist because you sprain your ankle, you won't get tax relief on it unless you've gone to a doctor and the doctor has advised you to go to the physiotherapist. If you have nursing home costs or you're employing a carer, you can claim those, and they're at your marginal rate of tax, which could be up to 40%. You get medical expenses for expenses that you have paid for yourself or your dependents, and your dependent in that situation could extend to your parents, for example. There are certain reliefs and incentives which I'll only mention in passing because it's beyond the scope of today, called the Startup Relief for Sure, or the Employment Incentive Scheme, or the Startup Capital Incentive Scheme, which if you're in a startup situation, you may want to talk to your tax advisor about. On your tax return, you also need to disclose certain items, so it's part of the revenue following the money. So you disclose if you have acquired certain assets, and as you can see there, you break down, shares, properties, and so on and so forth. Also, you disclose whether you received a gift or inheritance in the year, so it's a tick the box. Separate to that is whether you need to actually file a tax return, and that depends on how much you have got from what source and whether you exceeded a certain threshold, whether you're claiming certain reliefs like agricultural or business relief, and so on. The due date on the filing of a tax return for capital acquisition tax depends on the valuation date of the gift or the inheritance. Thresholds that apply for capital acquisition tax from parents: currently 400,000, from aunts, uncles, brothers, sisters 40,000, and from anybody else 20,000. But also don't forget the first 3,000 of a gift every year is exempt from tax. So if you're a parent and you have children, you could be passing 3,000 a year each to them every year, and while it's affecting your cash flow down the road, it is saving money, because if they are otherwise going to be down the road above the threshold, every 3,000 you pass over now at the current rate of 33% is saving 1,000 in tax down the road. For capital gains tax, payments for that is split into two categories. So anything that happens between January and November is payable by the 15th of December in the same year, and anything that happens in December is payable by the 31st of January. And quite often what happens is people don't tell their tax advisor about the capital gains tax, and it's only found out 10, 11 months later when they're doing a tax return, and the tax gets paid late and there's an exposure to interest. Obviously, revenue tax returns are all subject to self-assessment, and based on that, the revenue have the ability to pick out people for a revenue audit. So it's important that if you've claimed something, you've back up for what you've claimed, you have receipts, and you keep those so that if the revenue ask, you have the information. We've seen situations where people claiming medical expenses of only €200 and the revenue asked for the backup. We've seen situations where people claimed the working from home allowance and revenue have asked for proof from the employer as to the number of days they work from home, backup for the broadband bills, backup for the light and heat bills. They've claimed a pension, they want to see the receipt from the pension company, and so on. So people get tax advice from everywhere. It might be on the golf course, it might be at the bar, but in reality, if you're taking a certain course for a transaction, or not taking a course for a particular transaction, always consult your tax advisor to make sure that the advice that you get is good advice and based on your circumstances. And if you have any questions at all, please feel free to reach out.